Retiring with $6 million sounds like the dream, but what does life at this level really look like? I'll break down the freedoms, surprises, and the tough choices that come with it. And maybe you're at that dollar level or just trying to learn from those who are. We'll walk through a real client example. I'll reveal what's surprisingly similar and what's unexpectedly different about retiring with this level of wealth. So let's dig right in. Meet Brian and Lisa. Let's peek inside their retirement plan and all the questions and concerns they have. Yes, they have concerns. Most of our clients have saved in the $1 to $5 million range, but for our clients in that $6 to $10 million range, life is not as unlimited as you might think. But it certainly does afford them some opportunities if they get it right. Now, of course, I've changed their names for confidentiality and rounded asset values for simplicity. Brian's 64. He sold his HVAC company 2 years ago. He started the company in his late 20s. Then after selling it, he's managed the company as part of the buyout agreement. That's helped with the transition, and now he's fully retiring. Lisa's age 63 and worked in school administration, then went to work in the business when it started growing. They have 3 kids and 5 grandkids. When they came to us, here are the top priorities and concerns we worked through. So for priorities, they needed to create a sustainable spending plan. They wanted to know how to invest. Currently, they had a lot in cash and some old mutual funds, but no real organized plan. They want to travel and spend time with family. And then giving to charitable causes. This has always been important, and they're wondering if they can increase their impact. For top concerns, will they have enough income for their lifetimes, especially if they have unforeseen healthcare costs? They think they have enough, but can't really wrap their heads around it. Not getting killed in taxes. Well, they had a big tax outlay when they sold the business, and now they have all this money and they don't want to overpay the IRS. Then it becomes how to be smart with their money. Overall, they just didn't want to make bad decisions. And then they're undergoing this major life change. They're not in the business anymore. It's a different way of managing their money and their time. This is common to feel some nervousness going into retirement, especially after selling a business. So let's look at their assets. From the sale of their business, most of the proceeds went into a brokerage account. Much of it was in a money market fund when we started working with them, and they did pay capital gains when they sold the business. So the cost basis is pretty high in the new investments. It's quite common when retirees have higher levels of wealth. It's often come from a business sale or equity compensation like stock options. So it's not unusual for the largest account to be that brokerage account. In addition, Lisa has a Roth IRA, Brian has an IRA, and Lisa also has an IRA of $160,000. They added a large chunk into their bank accounts. They have savings and CDs, and their home is worth $1.4 million. They live in San Diego, where we're located. And in case you were wondering, that's a nice but fairly modest home in our part of the country. And they still have a mortgage, which will be paid off in about 5 years. It has a low fixed rate of 2.875%, so they're not in a rush to pay it off. So while $6 million is well above average, the people we work with in that range are hardworking people. They've often been frugal through their working years. They find it difficult to spend once they get into retirement because many of them have had to fight their way to earn a living, and they became successful because of that fight. As they earn more money, their spending may have increased, but it's not yachts and lavish lifestyles. It's more like buying higher quality to minimize repairs and replacing things. And I'm going to show you for Brian and Lisa what they actually spend versus what they could spend. So they have concerns because money doesn't solve it all. For business owners in particular, and even successful professionals, they're used to a feeling of a demand on their time and their attention. Work is more than 9 to 5. So then transitioning into retirement, it's often a bigger adjustment to reestablish purpose and an identity outside of the business. Those concerns are rooted in years of hard work and struggle. Then they get one shot when they can sell their business to make it count for a successful retirement. It's not enough to simply say, you have enough money. We have to build a framework for smart decisions well into the future. So let's look at how we addressed Brian and Lisa's pressing questions and concerns about spending, taxes, and investing. And along the way, I'll show you how we raised solutions to some things they did not think to ask about. So let's go back to our retirement income optimizer, and we'll start over on the right over here on your screen, and then we'll move towards the left. Brian and Lisa estimated that they needed $10,000 per month to live on aside from their mortgage. Well, we said let's plan for $12,500 per month instead, and here's why. First, we understand that most people underestimate what they spend, and it's doubly hard for business owners because income varies from year to year, and certain personal expenses like cell phones were wrapped into business expenses. On top of that, they had a mortgage payment of $39,000. That was a fixed payment over the next 5 years that will eventually drop off. And they felt more comfortable having a specific budget for travel of $10,000. And then taxes, more on that in just a minute. You can see this income surplus over here of over $90,000. Well, this helped them to see that they had more than enough to meet their core needs. I'll show you how we're making the most of this surplus and also how to monitor this in case of a severe market downturn. And this means they wouldn't need to withdraw all of this portfolio income, but they could. And that eased their concerns for that surplus to pay for long-term healthcare needs, which was a big concern for them down the road. So we addressed that healthcare concern with a solution that they loved. We moved $500,000 of this cash into a separate account earmarked for healthcare costs to provide a base. We invested for a balance of growth and conservative. And then the rest of the cash in the bank served as a reserve for them. Running the business, they always felt better when they had cash in the bank because in the early years, that was such a struggle. And even though they're not spending their full allowance, we'll use our risk-based guardrails here to determine if they can give themselves a raise if the portfolio jumps to $8.1 million. And if a major downturn comes about, in this case, it's $3.4 million, they can know to tighten the belt. How we set up the investment portfolio, factoring in growth and the possible downside, more on that in just a minute. And this is separate from the cash in the bank. Brian and Lisa had been flexible their whole life spending, so they love the idea that their plan will tell them if they need to reduce, rather than just having to guess if we go into a significant bear market. But let's take this a step further. We need to address their current tax picture. The good news for them is paying a lot of taxes on the business sale is now they have a high cost basis on those investments. So as it stands, if they withdraw income from that large brokerage account, taxes are fairly minimal in the early years. They have what we call this tax valley, and this is common to a lot of retirees. So because of this, we want to ask ourselves the question, can we take advantage of these very low tax brackets now in order to pay less taxes over their lifetime? It turns out we can. Because if we continue with mechanically withdrawing from their taxable brokerage account, and then the tax deferred, and then the tax-free Roth, they'll overpay lifetime taxes by $236,000, and that's in today's dollars. So we'll turn this around and we'll save that $236K through a series of Roth conversions in the early years to take some of their taxable traditional IRAs and convert them over to the tax-free Roth. But for Brian and Lisa, we're intentionally throttling the amount of Roth conversions, and this is because of their unique priorities. But before I get to where we found that Roth conversion sweet spot, let me address one thing you might be wondering. That is, Brian and Lisa have this huge brokerage account, and essentially they're underspending. Can't they just take income forever out of the brokerage account, pay minimal capital gains, and call it a day? The problem, as you might have guessed, is those required minimum distributions starting at age 73, when their IRA values are expected to be somewhere around 1.3 million. That means a good chunk of mandatory taxable income, even though they don't need it. So Roth conversions will help minimize that forced taxable income, but we need that sweet spot. If we overdo it, they've paid taxes up front for minimal benefit. And what I'm about to show you emphasizes how retirement planning really is customized. For Brian and Lisa, two of their priorities tie together their spending and their taxes. So one is their desire to give more charitably. So can they give more? The simple answer, because they're not using their full spending budget, is absolutely yes. They can give more on a consistent basis or even in some larger lump sums. But a large part of their giving strategy that we established with them will be giving directly from their IRAs once they turn age 70 and a half. These are called qualified charitable distributions, or QCDs. And these gifts directly from the IRA can proportionately satisfy their RMD once those begin. This is one major reason we don't want to convert all of their traditional IRAs to Roths. The second is they can now foresee leaving an inheritance to their kids since they're underspending. This is where doing the Roth conversions make a ton of sense. Even if Brian and Lisa, they're never going to touch that Roth money for themselves. They can let it compound for decades and pass it along to their kids tax-free. So doing Roth conversions is only the first part of the decision. Determining the amount based on their situation was super important. Next, we asked them, would you prefer to begin giving gifts to your kids during your lifetimes? This allows you to see them enjoy putting the money to use, and quite frankly, the kids probably have more use of the money sooner rather than later. Brian and Lisa love that idea to do their giving while they're living, as we say. But I will say, we didn't rush into these gifts to their kids for two reasons. One is they are just now retiring. Getting settled in and then adjusting to life and even getting an income in a totally different way may take some time. There's no need to rush gifts to their kids. Second is, with some time, we could better prepare their kids and even their grandkids for gifts and eventually an inheritance. I like to think that money can be like dynamite. It can be used for good or be incredibly harmful. So next on our agenda is to begin family legacy coaching, which we offer to our clients. This helps them identify their values and their overarching purpose in life, and then begin to communicate these values and the money aspects through family meetings. This helps align expectations, their legal estate documents, and creates a better atmosphere for collaboration among their children so the relationships are prioritized over the money itself. Now, to accomplish these opportunities, none of it works if the money is squandered. What Brian and Lisa realized, as they should, is good times and bad times both come and go when it comes to the economy and the investment markets. They had old mutual funds that were okay, but they had high expenses, and frankly, there was no real plan. They had a large amount of cash simply because they didn't know what to do with it. We've seen interest rates rise dramatically, but now start to decrease a bit. Since we already established a healthy cash reserve and that account earmarked for healthcare, we could focus on finding the right mix of growth and conservative investments. For Brian and Lisa, they have that $6 million, which, as we've seen, is more than they really need. They could either take on more risk than the average retiree, or they could get away with being more conservative. Their wealth expands their reasonable range. But here's where people often make their retirement investing mistake. You have to remember that going from a saver to an income taker changes the planning. Most mistakenly simply take their age and their risk preference and determine an asset allocation, or they just default to 60-40. While those are important considerations, they're still missing the key piece. So here's what we helped Brian and Lisa see. So we started by going back to their spending plan, specifically how much would they be withdrawing from their portfolio. And because they have that $92,000 surplus, they wouldn't be withdrawing $278,000, but more like $186,000. And we asked them, how many years of income do you want set aside in cash and bonds? Bear markets on average last 3 years from peak back to peak, and some of the worst have lasted 7 years. The goal here is when a bear market comes along, how long can we take income from the more stable investments so we can allow stocks to recover and not have to sell them when they're down 30 or 40%? Well, Brian and Lisa initially responded that 10 years of cash in bonds would help them sleep at night. So let's round it up to $190,000 per year that they need to withdraw from their portfolio over 10 years, or $1.9 million. So we take that over the $5.5 million that they have at total investments, not counting the cash and that separate healthcare money. Well, it's 35% that would go to cash and bonds. They felt really good about this, and after some final discussion, they rounded down to 30% in cash and bonds, given that they also had a large cash reserve and that healthcare account, and that we were also estimating high on their expenses. This meant 70% could be invested in stocks for growth over the long term, and they felt very comfortable with that. Going through this exercise can now help them sleep better at night. Previously, I posted a full video where I go through not only how to construct the original asset allocation, but how to manage the buckets for cash, bonds, and stock. You can click on that video on the screen or find it in the link in the description. And like Brian and Lisa, if you want to make sure to get things right in your retirement, from the spending plan to minimizing taxes, the investments, and even incorporating family legacy planning, set up a call with one of our CFPs. You can find a link in the description down below. Thanks for watching, and we'll see you on the next video.